Shanghai silver plunges 2.86% today, faster than COMEX, but the premium still won't close. A number moved this morning that was never supposed to move this way. Shanghai fell first. New York followed. The rule that every silver investor has trusted for decades just broke. And yet, the one signal that should have collapsed under that pressure refused. It held. Why? Because what happened today is not what it looks like on the surface. There is something running underneath this market, something slow, something structural, that one bad session cannot stop. And by the end of this video, you will understand exactly what that is. Welcome back to John Stark AG. Now, before anything else, if you have been around long enough to remember when markets made sense, when discipline mattered, when people actually studied before they spoke, this channel was built for you. Think of subscribing the way you would think of renewing a trusted newspaper subscription. You did not cancel it when the headlines got uncomfortable. You kept it, because reliable, clear analysis is worth holding on to. If that sounds familiar, hit that subscribe button. It costs nothing, and it means you will not miss a single briefing. Now, drop a comment below and tell the community where in the world you are watching from. The city, the country, wherever you are sitting right now. This community spans more corners of the world than most people realize, and every location adds something to this conversation. There is a rule in precious metals markets that is held, with rare exceptions, for as long as most professional traders can remember. When something breaks in silver, when fear moves through the market, when a macro shock arrives, when positioning shifts suddenly and violently, it breaks in New York first. COMEX sets the tone. Shanghai follows. That is the order. That has always been the order. Today, that order was reversed, and almost no one covering this market noticed it happen in real time. On the morning of July 7, 2026, Shanghai silver fell 2.86% in a single session. COMEX, the Western benchmark that is supposed to lead, declined by approximately 2.3% over the same window. Shanghai did not follow New York today. Shanghai led it, and it did not just lead it narrowly. It fell faster, fell harder, and fell first. That is the anomaly. That is the number that should not have moved this way. Here is what the data board looks like right now, because the numbers matter, and they matter precisely. Shanghai spot silver is trading at $63.74 per ounce. Western spot, the COMEX referenced benchmark, sits at $57.36. That places the Shanghai premium at 11.12% or $6.38 above the Western price. Based on the prior Shanghai Gold Exchange close, today's session represents a drop of roughly 2.86% for Chinese silver. Western spot over that same window slid from approximately $58.70 down to $57.36, a decline of around 2.3%. The gap is clear. Shanghai moved faster, Shanghai moved harder. Now here is what makes this genuinely unusual. The Shanghai market is not supposed to behave this way. It is not a paper market. It is not a market driven primarily by hedge funds in Chicago, rolling futures contracts they never intend to settle with physical metal. The Shanghai Gold Exchange is built around physical delivery. When Chinese industrial buyers, solar manufacturers, electronics producers, state-aligned accumulators take a position in that market, a meaningful share of that activity ends up as real metal moving into real vaults. That physical anchor is supposed to cushion Shanghai from exactly this kind of sharp, fast decline. The premium that Chinese buyers pay over Western spot exists precisely because of that physical demand. It reflects something real, genuine appetite for the metal, structural friction that prevents easy arbitrage, and an import licensing regime that the Chinese government tightened as recently as January of this year. All of that cushion was in place today, and Shanghai still fell faster than COMEX. But here is the part that changes the entire meaning of today's session. The premium did not close. After a session in which Shanghai fell harder and faster than the Western market it is supposed to be insulated from, the gap between the two prices barely moved. It is sitting at 11.12%, essentially unchanged from where it has been running for weeks. Both prices fell. They fell in roughly the same proportion, and the distance between them held almost perfectly steady. That combination, faster price decline plus a premium that refuses to compress, is not the signature of collapsing Chinese demand. A loss of confidence in silver would hit the premium first. The premium is the part of the price that exists because Chinese buyers are willing to pay more than the rest of the world. If those buyers were walking away, that number would shrink. It did not shrink. It held. What the data is describing then is not a breakdown in Chinese physical demand. It is a market repricing against a powerful global macro shock, the same shock hitting every silver market simultaneously, from Chicago to Shanghai, while the underlying physical tightness inside China remains completely intact underneath the surface. To understand why that distinction matters so much, it helps to zoom out for a moment and look at what the medium-term picture actually shows. Over the past 6 months, Western silver is down roughly 24% from its highs. Shanghai silver, over that same period, is down approximately 21.9%. That is a meaningful difference, and it tells a story that the daily headlines tend to miss entirely. The Western paper market has actually been the weaker of the two over the medium term. It has fallen harder than the physically anchored Chinese market across a sustained stretch of time. Today, for one session, that dynamic reversed. Shanghai led, COMEX followed. The question that matters, the question that will determine what this moment actually means for anyone holding physical silver, is whether today's reversal is a signal of something changing inside China's physical market, or simply a single session where global macro pressure arrived fast enough to outpace even Shanghai's physical cushion. The premium refusing to close is the first piece of that answer. It is not the last. Most people watching silver today think they understand what happened. They saw the price drop, they read the headline, they connected it to the Federal Reserve, to rate hike fears, to a market that has been under pressure for weeks. And they moved on. What they missed is the chain. Not the individual events, those are visible enough. What they missed is how those events connect to each other, how one feeds into the next, how a conflict in a narrow stretch of water between Iran and the United States ends up moving the silver price in Shanghai on a Monday morning in July, how a single Federal Reserve meeting in June is still sending shockwaves through Chinese industrial purchasing decisions 6 weeks later. That chain is what this part of the story is about. Because once it is understood clearly, today's session stops looking like noise and starts looking like something far more deliberate. Begin with the man at the center of it. On June 17, 2026, Federal Reserve Chair Kevin Warsh ran his first FOMC meeting since taking the position. Markets had been watching carefully. Warsh had signaled a different approach, more direct, less guided, less reliant on the forward communication tools that his predecessors had used to manage market expectations for over a decade. What he delivered confirmed the signal. Warsh scrapped the traditional dot plot format. The dot plot, the Fed's published projection of where individual committee members expect interest rates to go, has been a cornerstone of market communication since 2012. Traders, institutions, and central banks around the world have used it as a roadmap. Warsh removed it. In doing so, he removed the roadmap and replaced it with uncertainty. The committee itself came back divided. Available projections from 18 of 19 members landed closer to a 9-9 split than the clean hawkish mandate the initial headlines suggested. But headlines move markets faster than nuance does, and the headline that stuck across every trading desk from London to Singapore was simple and brutal. Warsh is hawkish. Rate cuts are off the table. Rate hikes are now in play. CME FedWatch data currently shows the probability of a September rate hike sitting in the low 60% range. Bank of America has gone further, forecasting 3 separate 25 basis point hikes across September, October, and December. That path would push the federal funds rate to a range of 4.25% to 4.5% by year-end. Here is the twist that most coverage of this story completely ignores. Silver reached $120 per ounce earlier this year. That run, one of the most dramatic in the metal's modern history, was built on a foundation of cheap money, falling real rates, and the widespread expectation that the Fed's next move would be a cut. Institutional positioning reflected that expectation. Physical accumulation reflected that expectation. The entire bull thesis that drove silver to $120 was, at its core, a cheap money thesis. Bank of America is now saying that era is not just pausing, it is actively reversing. If 3 hikes land as forecasted, the conditions that built the $120 silver move will not simply be on hold, they will be structurally dismantled. That is not a minor repricing, that is a fundamental reassessment of the environment that created the opportunity in the first place. Layer on top of that the inflation data feeding this hawkish narrative. May's PCE reading, the Federal Reserve's preferred inflation gauge, came in at 4.1%. Hot enough to validate the hawkish pivot rather than complicate it. May's headline CPI ran at 4.2% year-over-year. Elevated, persistent, and driven in large part by a roughly 23.5% surge in energy prices. That energy spike is where the story takes a turn that most analysts have failed to properly connect. The energy surge is not random. It is tied directly to the conflict between the United States and Iran, specifically to tensions surrounding the Strait of Hormuz. The Strait of Hormuz is the narrow passage through which approximately 20% of the world's traded oil flows. When military tensions rise in that corridor, oil prices spike. When oil prices spike, energy inflation rises. When energy inflation rises, headline CPI rises with it. When CPI rises, the Federal Reserve has political and institutional cover to keep hiking. When the Fed keeps hiking, non-yielding assets like silver get crushed. That is the chain. Iran and the Strait of Hormuz are not a separate geopolitical story running parallel to the silver market. They are inside the silver market. They are part of the mechanism that produced today's session in Shanghai. Now here is where the story gets significantly more complex and more important. Reports indicate that the United States and Iran agreed to a fragile halt in hostilities around the Strait of Hormuz. A meeting between an Iranian delegation and American representatives was scheduled in Doha, Qatar, today, June 30th. That ceasefire, if it holds, removes the energy pressure feeding the hawkish inflation narrative. Oil pulls back. CPI cools. The Fed loses some of its cover for aggressive hikes. And silver, along with gold, gets room to breathe. But if that ceasefire breaks down, if the Doha talks collapse, if hostilities resume, if oil spikes again, every element of the chain that crushed silver today tightens further. The inflation pressure intensifies, the Fed's hawkish path becomes more entrenched, and the selling that hit Shanghai this morning is not a single session event. It becomes the opening chapter of something much longer, two live wires, running simultaneously, neither resolved, and there is a third. Federal Reserve Chair Kevin Wersch is scheduled to speak tomorrow, July 1st, at the European Central Banks Forum in Sintra, Portugal. This will be his first major public commentary since the June FOMC meeting. Markets will be listening for tone, not just content, tone. Any softening, any acknowledgement that the energy-driven inflation spike might prove temporary, any hint that the 9-to-9 committee split reflects genuine internal debate rather than a unified hawkish front could trigger a meaningful relief rally across the entire metals complex. A reaffirmation of the hawkish stance does the opposite. Then Thursday arrives, July 2nd. The U.S. jobs report, moved up a day because of the Independence Day holiday. Consensus sits around 115,000 jobs added, with unemployment holding near 4.3%. Those numbers, if they land near expectations, would ease September hike odds and give silver room to stabilize. But May's report blew past expectations at 172,000 jobs against a far lower forecast. That single beat triggered a sharp sell-off in both gold and silver within hours of the release. If Thursday delivers a repeat, strong job creation, hot wage growth, unemployment falling rather than holding, the September hike probability does not stay in the low 60s. It moves toward certainty. And the pressure on silver does not ease. It compounds. 3 catalysts, stacked inside a 72-hour window. Doha, Sintra, Thursday's jobs data. Today's Shanghai session may not be a verdict on silver at all. It may simply be institutional positioning, large players in Asia de-risking ahead of a weekend that could deliver any one of 3 different outcomes, each capable of moving markets sharply in either direction. But here is the detail that separates today's story from a standard risk-off session, and it is the detail that brings everything back to Shanghai specifically. When global macro pressure builds the way it has this week, Chinese industrial buyers are typically the first to pull back on near-term purchasing. Solar manufacturers, electronics producers, state-aligned accumulators, these are buyers with production schedules and capital allocation frameworks that require certainty before committing. When 3 major catalysts are unresolved inside a 72-hour window, those buyers wait. They do not exit. They pause. That pause moves the Shanghai benchmark faster than COMEX. Because COMEX is a paper market, speculative positioning takes a session or 2 longer to fully reprice through futures rolls and margin calls. Shanghai, built around physical delivery, responds immediately to the hesitation of buyers who actually need the metal. Shanghai did not crash today because Chinese demand for silver collapsed. Shanghai crashed today because the buyers who underpin that demand chose to wait for Doha, for Sintra, for Thursday, before committing further capital at current levels. That is a completely different diagnosis than what the headlines are suggesting. And the difference between those 2 diagnoses is the difference between a temporary pullback in a structurally intact market and the beginning of something far more serious. The premium is still holding at 11.12%. That number is not decoration. It is evidence. Evidence that the pause is a pause, not a departure. But whether it stays a pause depends entirely on what comes out of those 3 catalysts. And one of them, the one that markets are most underestimating right now, carries a structural implication for silver that goes far beyond a single jobs report or a single Fed speech. That implication has been building quietly for 6 consecutive years, and it does not care what happened in Doha today. There is a number that has been sitting quietly in the background of today's session. Not the price drop, not the percentage decline, not the COMEX spread. The number is 11.12. That is the Shanghai premium, expressed as a percentage above Western spot silver. Right now, in this moment, after one of the sharpest single-session drops the Chinese silver market has recorded in recent memory. It has barely moved, and that fact, that single, stubborn, unmovable fact, is the most important data point in the entire silver market today. Not because it is dramatic, but because of what it proves, quietly and without argument, about what is actually happening beneath the surface of today's sell-off. To understand why, it helps to think clearly about what the premium actually represents. The Shanghai premium is not a technicality. It is not an accounting artifact. It is the price that Chinese buyers, industrial manufacturers, state-aligned accumulators, electronics producers, solar panel fabricators, are willing to pay above and beyond what the rest of the world pays for the same metal. It exists because demand inside China is real, physical, and structurally constrained in ways that prevent easy arbitrage from closing the gap automatically. If Chinese buyers were losing confidence in silver, if the demand that has sustained that premium for months was genuinely cracking, the premium would be the first thing to compress, not the last, because a loss of confidence hits willingness to pay first. It hits the premium before it hits the price. Today, Shanghai's price fell 2.86%. COMEX fell 2.3%. Both markets declined in roughly the same proportion, and the gap between them, $6.38 per ounce, 11.12%, held almost perfectly steady. That is not the signature of demand collapse. That is the signature of a global macro shock repricing both markets simultaneously, while the physical tightness inside China remains completely structurally intact. Now here is the twist that most analysts covering today's session have entirely missed. The structural demand infrastructure that holds that premium in place did not develop overnight, and it did not weaken overnight either. It has been building, quietly, systematically, deliberately, for well over a year, and the data, when laid out clearly, tells a story that one bad trading session cannot touch. Start with China's silver import licensing regime. In January of this year, the Chinese government tightened the controls governing how silver enters the country. That decision was not accidental and it was not minor. Licensing restrictions on physical silver imports create a structural floor beneath Chinese demand by limiting the supply that can flow in to meet it. When supply is artificially constrained and industrial demand continues growing, premiums do not compress easily, they hold. Sometimes they expand. Those restrictions are still in place today. They did not loosen because COMEX repriced lower. Layer on top of that the VAT structure on physical silver imports, a cost friction built into the Chinese import system that makes arbitrage between Western and Chinese prices significantly harder to execute than it appears on paper. Every time a trader looks at the 11.12% gap and thinks about closing it by importing metal, the VAT structure quietly makes that trade less profitable than the headline spread suggests. That friction is structural. It is persistent, and it is one of the key reasons the premium has refused to close across weeks of Western price weakness. Then consider what the People's Bank of China has been doing, not with silver but with gold, because the two stories are connected in ways that matter enormously. The PBOC has been on an 18-month consecutive gold buying streak. Current reserves sit at approximately 2,332 tons, representing roughly 9% of total Chinese foreign exchange reserves. In April alone, the central bank added 8 tons in a single month, marking the largest single-month increase since December of last year. China's silver imports hit a multi-year high in the first quarter of this year. Gold imports over the same period came in at nearly 3 times the prior pace. Read that again carefully. While Western markets were repricing precious metals lower, while the paper futures complex in Chicago was adjusting positioning around hawkish Fed expectations, China was importing silver at a multi-year high rate and gold at nearly 3 times its previous pace. That is not the behavior of a country losing confidence in hard assets. That is the behavior of a country accelerating its acquisition of hard assets while Western paper markets create temporary price dislocations that make acquisition cheaper. Now here is where the story deepens in a way that most short-term market coverage never reaches. The Silver Institute, the industry body that tracks global silver supply and demand with the most comprehensive data available, has now confirmed 6 consecutive years of global silver deficits, 6 years in a row where the world has consumed more silver than it has produced. The shortfall for this year alone is estimated at approximately 46.3 million ounces. The cumulative drawdown from above-ground stockpiles since 2021 has now exceeded 760 million ounces. 760 million ounces pulled from global stockpiles in 5 years. That number does not pause because the Federal Reserve raised the probability of a September rate hike. It does not pause because Shanghai had a difficult trading session. The industrial engine driving silver demand, solar panel manufacturers with government-mandated clean energy targets, electric vehicle producers with production schedules built months in advance, electronics fabricators with procurement contracts that run quarters ahead, none of them redesign their supply chains because COMEX repriced lower on a Monday. The industrial clock runs on a completely different schedule than the monetary clock. And today's session is almost entirely a monetary clock story, but here is the twist. The one that genuinely changes the risk calculus for anyone thinking seriously about this market. The monetary clock and the physical clock are not just running at different speeds, they are now running in opposite directions. The monetary clock, Fed policy, rate hike expectations, macro positioning, is pushing silver prices lower in the near term. That is visible, measurable, and reflected in today's session. The physical clock, 6 years of deficits, tightening Chinese import controls, accelerating sovereign accumulation, growing industrial demand, is pulling on silver's structural floor from below. That force is slower. It is quieter. It does not show up in a single session's price action, but it is relentless. When two forces of that magnitude run in opposite directions, something eventually gives, which brings the analysis to COMEX, because the western side of this equation carries its own structural warning that has been developing quietly alongside everything happening in Shanghai. COMEX registered silver, the portion of vault inventory actually available to satisfy delivery against open futures contracts, has been trending lower over the past year. Total vault holdings have drifted down from their peak, but registered stock, the deliverable buffer, has been shrinking faster than total holdings. That means the ratio of paper claims to physically deliverable metal has been climbing, not because more paper has been created, but because the physical metal backing it up keeps getting smaller. There is no delivery failure today, there is no immediate crisis, but the buffer protecting the system from a real squeeze keeps getting thinner, even during weeks when the headline price is falling. A falling price and a tightening physical buffer can coexist. They are coexisting right now, on both sides of the Pacific simultaneously. Shanghai expresses it through a premium that will not close. COMEX expresses it through a registered float that keeps shrinking beneath a price that does not reflect either fact. Now hold both of those facts together for a moment and consider what they are collectively describing. Two of the world's major silver pricing mechanisms, one in Shanghai, one in New York, are both showing signs of physical tightness at the same time that the monetary complex is driving prices lower. The paper price is falling. The physical signals are not confirming that fall, they are contradicting it. That contradiction has a name in market analysis. It is called divergence. And sustained divergence between paper pricing and physical signals has historically not resolved in favor of the paper market. It has resolved in favor of the physical. But before that resolution arrives, if it arrives, the monetary clock has one more set of catalysts to run through. And one of those catalysts carries a risk that the bull case for silver has not yet fully priced in. The jobs report on Thursday is not just a data point, it is a potential acceleration trigger for everything that has been building since June 17th. And the last time a jobs report came in, the way consensus is quietly whispering this one might, silver did not stabilize, it fell sharply. Within hours. There is a moment in every market cycle where the noise gets loud enough to drown out the signal. This is that moment. Rate hike fears, a fragile ceasefire, a jobs report that could swing positioning across the entire metals complex within hours of its release. Shanghai falling faster than COMEX. Headlines moving faster than analysis. Every voice in the financial media offering a verdict on silver, and most of those verdicts arriving before the evidence is fully assembled. Here is what the evidence actually says. Start with the bear case. Because it is real, it is specific, and anyone holding silver right now who is not taking it seriously is not thinking clearly. Bank of America's 3-hike forecast is not a fringe call. It is a major institutional projection from one of the largest financial institutions on the planet. If that forecast plays out exactly as described, 3 separate 25 basis point hikes across September, October, and December, the federal funds rate ends the year at 4.25% to 4.5%. That is not a minor adjustment to the monetary environment. That is a fundamentally hostile backdrop for any non-yielding asset. Silver pays no interest. It generates no dividend. In a world where cash yields 4.5% and the risk-free rate is rising, the opportunity cost of holding silver rises with it. Goldman Sachs has already moved. Their year-end gold target has been cut from $5,400 down to $4,900, a $500 reduction driven by the complete removal of 2026 rate cuts from their forecast. Goldman is not removing those cuts because they expect the economy to weaken. They are removing them because they expect inflation to remain stubborn enough to keep the Fed on hold or moving higher. If gold grinds lower under that pressure, and Goldman's revised target implies it will, silver's monetary engine gets dragged down with it. Regardless of how tight the physical market in China remains, monetary pressure does not care about structural deficits in the short term. It overrides them, and it can override them for longer than most investors expect. Then there is Thursday's jobs report. Consensus sits around 115,000 jobs added, with unemployment near 4.3%. Those are the numbers the market has priced in. A print near that range would be manageable. It would ease September hike odds modestly and give silver room to stabilize around current levels. but May's report came in at 172,000 against a far lower forecast. That single beat triggered a sharp, fast sell-off in both gold and silver within hours. The mechanism is straightforward. A strong jobs number reduces the Fed's incentive to pause, raises the probability of the next hike arriving sooner, and triggers immediate repositioning across the metals complex. If Thursday repeats that pattern, strong job creation, hot wage growth, unemployment falling rather than holding, the bear case does not remain a forecast. It becomes a live, accelerating reality. And silver, sitting where it sits today after already declining significantly from its highs, faces another leg lower with limited near-term support. That is the honest bear case, plainly stated. Now here is the twist. Because the bull case is not built on hope or historical sentiment, it is built on the same quality of institutional data, and it points in a completely different direction. JP Morgan has held its fourth quarter gold target at $6,000 after Goldman's downgrade, after the hawkish Fed repricing, after everything that has hit the metals complex since June 17th. JP Morgan has not moved. That is not stubbornness. That is a different analytical conclusion from an institution with as much access to data as any entity on the planet. JP Morgan's position implies one specific belief, that the rate hike repricing currently crushing precious metals will exhaust itself before year-end, and that when it does, the move back toward hard assets will be sharp and significant. The World Gold Council's 2026 survey of global central banks found that the overwhelming majority of the 76 institutions surveyed intend to keep adding to gold reserves. 76 central banks, not retail investors, not speculative funds, sovereign institutions with multi-decade investment frameworks adding to hard asset reserves at a record-setting pace. That signal does not come from this week's Fed-driven volatility. It comes from a structural reassessment of the global monetary system that has been building since 2022. And then there is the gold-silver ratio. It currently sits at 69-1. That means it takes 69 ounces of silver to buy 1 ounce of gold. The long-run historical average sits closer to 65-1. That alone suggests silver is undervalued relative to gold on a relative basis. But the historical range tells the deeper story. During the peak of the COVID panic, that ratio reached 127-1, the most extreme silver undervaluation in modern history. During this year's tariff truce rally, it compressed all the way down to 54.9-1. That compression, from 127 down to 54.9, happened in a matter of months. When the ratio moves, it moves fast, and it moves in silver's favor. A ratio sitting at 69-1, well above its long-run average, well below its crisis peak, is historically the kind of reading that precedes sharp silver outperformance once the rate hike fear driving it finally peaks, not gradually, sharply, within weeks of the macro wind shifting even slightly. Now here is what to watch, specifically, concretely, and with clear thresholds. First, the Doha talks outcome. A genuine documented de-escalation between the US and Iran that holds through the week removes the energy-driven inflation pressure feeding the hawkish Fed narrative. Oil pulls back. CPI gets a tailwind toward cooling. The Fed loses some of its cover for aggressive hikes. A breakdown does the opposite. Oil spikes, inflation re-accelerates, and the chain that produced today's Shanghai session tightens further. Second, Kevin Wersch at the ECB Forum in Sintra, July 1st. Listen for tone, not just content. Any softening, any acknowledgement that the energy inflation spike may prove temporary, any signal that the 9-9 committee split reflects genuine internal debate, represents a meaningful shift. A reaffirmation of the hawkish stance confirms the trajectory. Third, Thursday's jobs report, July 2nd. The number to watch is not just the headline, it is wage growth. Wages drive services inflation. Services inflation is the component of CPI that the Fed cannot blame on Iran or oil. A jobs number near consensus with contained wage growth gives silver room. A blowout beat with hot wages removes that room entirely. Fourth, and this is the watch point that matters most for the structural thesis, keep watching the Shanghai premium, not just today, over the next 2 to 3 weeks. As long as it holds near 11%, the physical demand thesis remains intact beneath the monetary noise. But if that premium genuinely begins to compress, not just hold steady through a bad session, but actually shrink toward 5% or 6% over a sustained stretch, that is the real signal. That would mean Chinese physical buyers are not pausing, they are leaving. And that would be a fundamentally different and far more serious development than anything seen in today's session. Now, here is the framework for thinking about all of it. Markets move on 2 completely different clocks. There is the monetary clock. It ticks on Fed meetings, jobs reports, inflation prints, and ceasefire headlines. It is running fast right now. It is running loud. It is hawkish, uncertain, and genuinely capable of pushing silver lower in the near term if Thursday's data confirms the worst case. And there is the physical clock. It ticks on solar installations in Xinjiang, EV production lines in Shenzhen, a sixth consecutive year of global silver deficits that does not care what was decided in Doha, and 760 million ounces of cumulative stockpile drawdown that does not reverse because a Federal Reserve chair changed his tone at a forum in Portugal. Today, in this session, the monetary clock won. It won faster in Shanghai than in New York. It moved harder, and it moved first. But the physical clock is still running underneath it, quietly, structurally, without drama. And the premium, sitting at 11.12%, unmoved, stubborn, refusing to close despite everything the monetary clock threw at it today, is the proof. The investors who navigate this period successfully will not be the ones who react fastest to the monetary clock. They will be the ones who never forgot the physical clock was still ticking while everyone else was watching the other one. Do not confuse a fast clock with the right clock. They are both real, they just move at different speeds. And right now, one of them is being completely drowned out by the noise of the other. That is the single most important thing to understand about silver in this moment. Not the price, not the percentage drop, not the Fed forecast or the jobs report or the premium level. The clock you are listening to, choose carefully. This is for education and discussion purposes only, not financial advice. The data, the structure, and the analysis presented here are tools for independent thinking. Every decision must be weighed against individual circumstances and risk tolerance. If this breakdown gave you clarity, subscribe to John Stark AG. Leave a comment below telling the community where in the world you are watching from. And if you found value here, a like takes 2 seconds and it tells the algorithm that serious, data-driven analysis still has an audience worth serving. Invest with logic, never with noise.